Hey guys, welcome back to the channel. Today, I wanted to walk you through a crazy trend continuation strategy. Now, this is something I used to use back in my day trading days, but like anything else, you can use it on any chart, any market, any time frame. Now, I want to warn you guys before we hop in, this may be a little bit advanced, and I don't mean that in like a braggadocious way where it's like I'm smarter than you, but it's a bunch of different techniques kind of put into one. And typically my philosophy on trading is keep it as simple as possible because me not the smartest, and I know that a lot of newer traders check out the YouTube channel here, but I say that because I don't want you guys to get overwhelmed. Instead, focus on the general philosophy of what we're looking for while we're looking to get involved, all the stuff about risk reward and active trade management instead of the specifics of like Fibonacci's and this and that. All right, let's hop in. If you have any questions, leave them below. You can look for the same stuff on the 15. Again, it's going to change a little bit. So hourly, 4 hour, you're certainly waiting for a pullback. Most likely it's going to be to this whole area, like is the technical area. Probably this is more realistic right here, but this whole area is the technical area of where you're looking for that pullback to come to. When you go down to like a 15-minute chart, because you have newfound structure, you can look for a smaller zone. Now there's a gift and a curse to this, right? And this is where, this is a good example of the Fibonacci inversion trade. Yes, I get to talk about it. Perfect. So this is cool. So on a 15-minute chart, you can certainly look for a pullback here and a chance to get short. Would you guys agree? Yeah, right? Now, here's the interesting part. And this is where the Fibonacci inversion, this was a day trading strategy I used to use, mainly on the range bar charts. I never used it on the regular candles, the minute-based charts, but the same theory kind of goes into play. So, and you got to keep in mind that you're looking at this from a perspective of already doing top-down analysis, right? So if the market were to do this, here's my question for you. If the market were to go up here, could you still look for a trend continuation play? This is a tricky one, and this is going to be one where I always categorize this strategy as saying it is one where the rules don't actually make sense, but they kind of make sense. Now, real quickly, just to make sense of the thing that doesn't make sense, our philosophy here at Tier 1 Trading is rules-based trading, meaning that you want to have a systematic approach to what you're doing in the market. So what we do is we assign rules. That way we can see something and analyze something as consistent as possible. Now, with that being said, the market isn't meant to follow our rules, right? It's kind of like quantum physics. We create this stuff, but the universe doesn't really have to follow it. So there are going to be circumstances where we have a rule, but the market does something different from that rule, and it doesn't always make sense. So yes, especially as new traders, we want to stick to those rules. And if we have a situation like that, when in doubt, stay out. We just ignore it and wait for the opportunity that does meet our rules. But I do want to put that out there because sometimes, or often I should say, we get questions from traders that say, well, Akil, the rules say this and this and this, and how come the market didn't follow it? And the truth is, kids, cover your ears, the market doesn't give a about our rules. This is technically a violation of our trend, right? Because if we are looking at this as our new structure low, our outside return, our new structure low, we know that if the outside return is violated, then boom, the trend is violated, right? Would you guys agree? Per our rules, if outside return violated, then trend is violated. It is in rotation. Would everyone agree with that? Right? So this is where the dilemma comes in because you have a violation of trend. Therefore, if you have a violation of your bearish trend, you should no longer be looking to get bearish. But here's the thing. On your higher time frame, going back to the hourly, does a move right here violate the trend at all? No, right? And this was the interesting thing with day trading because you see so many of those kind of micro trends, right? The trends within the trends within the trends, that you're going to get those ebbs and flows, which are good for day trading, but you're also going to get these things where sometimes they are violated on that lower time frame, but not violated on your higher time frame. So this is where the Fibonacci inversion tactic came in. And here's what you would do, right? And I haven't looked at this yet, so we'll see if it actually lines up. But here's what you would do, right? So let's pretend price has gone up here and violated this trend, right? And what the market is doing is it's tricking you, right? They're tricking you into thinking that the trend has been violated when it really hasn't been violated, right? And there's the whole institutional thing that I shared with you guys in the Trading Coach podcast about that a couple weeks ago, or was it earlier this week? I don't know. At some point I shared it with you, so we're not going to dig into that again. I trust you listen to that episode. But here's what I like to play this, right? I used to do this. I used to take my Fibonacci extension tool, invert it from my low to that outside return and back down. And the key trigger for me, right, was the 618 or 1618, excuse me. I then took my Fibonacci retracement from the previous swing high of the quote unquote the real downward move, right, to here. Oh, this is going to work perfect. And boom, the overlap. And I looked for the 618 Fibonacci retracement to overlap with the 1618 Fibonacci inversion to be right at a level of structure, right? So for you guys that are not familiar with fibs, the 618 and the 1618 are the golden mean and the inverse golden mean. Like these are the most powerful ones. That's why they're in red. So to have those overlap, and then for me too, because I'm a structure guy, to have those overlap and be at a level of structure, this was an aggressive trade for me. Now my mentor, he was super aggressive. Jason Stapleton used to put a limit order right here. And I remember having conversations with him because I started off very, very, very conservative. I needed again, double top. I needed RSI overbought. I needed diversions. I needed every single signal to tell me that it was good to go. And I remember talking to him, like, dude, how do you do that? Like, how do you have the cojones to do that? He's like, man, he said, I know my numbers. I know how good this trade is. He said, I don't care if it spikes a little bit above. I just know that once it hits this zone, I want to get in and I don't want to wait. You with me? Leroy Jenkins, right? No. But yeah, this was one of my favorite trades. Now, I did this strictly on range bar charts. But it was man, I loved it. And then what you're doing is you're playing the same trend continuation play, right? So we could look at targets or stops a few ways, right? We'll do a aggressive and a conservative one, right? So we're going to have to go back and mark up our charts again and remember where we were looking at this stuff at. But we were looking at, say we're looking at shorts right here. We'll give a few levels, but we were looking at, I'm going to have to go back to my hourly, sorry, because I deleted all my stuff. Oh, we're looking at right here as being a potential target one, and then we're looking at right here. This is that elephant candle. We'll make it 144 to make it an even handle number as our target two. And I want you to look at this. We'll map it out from a few levels. I'll give everyone an opportunity to get involved, right? So the super most conservative person, right? Where do you think the most conservative, well, there's a few different stop loss targets. Where do you think a very conservative target would be at in this trading opportunity? Probably the most conservative one would be a retest of this white line, right? But remember, we're looking trend continuation. So what do you guys think? Retest of the lows? And again, I just want to, there's no wrong or right answer here, right? Every trader is a little bit different. So we just want to give out different options for how you would look at this, right? Retest of the lows is one, right? So let's do it there. And we'll worry about stop losses later, right? So a second option right here would be that first level of structure that we identified, right here. That's the second option. And of course, there's tons more. You can bring in a Fibonacci and look for a 1618 Fibonacci extension down there. I'm making the face because I knew it was going to be down there. I saw it, right? So you have 1618 Fibonacci confluence right there. And then you could do a third one or a target two. Or if you're just super aggressive, right? That 144 even handle, which is way down here, right? And we talked about this yesterday when we were talking about day trading. And, when you have a chance to go for it, you go for it. Not with your full position, but when you have a chance to go for it, you go for it. And look at this opportunity right here, right? Boom, boom, boom. Now we can talk about risk reward. A very aggressive risk reward tactic would be getting above this level. So let's say you're waiting for a lower low, lower close. You're waiting for a double top, right? The same tactic that we always use with ATR. That would probably put your stop loss like pretty much somewhere where it's at right here, right? So you look at this level right here and you can see what your risk reward looks like, right? Hell yeah. Hell yeah. 10 to 1, 5 to 1, 3 to 1, 2.5 to 1. Hell yeah, right? But now here's the thing. If you want to be more conservative, because you have such a good risk profile, right? If you're someone that's like, man, like I want to give this all the breathing room possible, because again, can market go here and still be in our bearish trend? Yes. So it's an aggressive risk, right? It's small and everyone likes small, but it's not at a place that actually tells us we're wrong, because this can easily be a complex pullback and continue up. The level that we know we're wrong is going to be if market violates this level. So can you have your stop loss above that level? We'll just put it here. Again, we're not going to do the calculations right now. We'll just put it here. Well, still a decent risk profile on the smallest target. Still a really good 2.6 to 1 on the middle target. No more 10 to 1, but you still got a 5 to 1 on your aggressive target. You still got a good risk profile either way, right? So again, there's no wrong or right answer. It's up to your personal preference. For me, I know if I'm shooting for a big trade, I like to give myself breathing room, because you guys know how I judge myself. The thing that I hate the most isn't losing or anything like that. It is being right on a prediction, but not having the opportunity to get involved. Whether that's like me missing a trade or me putting a stop loss in a bad place. Like I don't want to have price rally up to here and then go all the way down and be like, I did everything right, but just put a stop in a non-secure place. So I'm willing to give myself more breathing room. And then what I'll do is, let me ask you guys a question, because this is my style of coaching is I want you guys to be involved. If I have my stop loss up here, wherever it may be, what do you think I do to, I don't want to give the answer away, to assist myself if price starts going in my favor? There wasn't a way to word it without giving the answer away. But what type of tactic do you think I use? This is where you implement a risk management tactic, an active trade management tactic. Yeah, where once price starts moving in your favor, right? Roll that stop down, roll that stop down, roll that stop down. Maybe not directly to break even, but hopefully you have a chance to get it closer and closer and closer. And now, as price is going in your favor, as price is proving that your prediction is correct up to this point, you're now reducing your risk on the back end. You still have your available profit there for you, but now you're managing your potential losses, and there's no better place a trader wants to be. Roll that stop. Woo!
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on display.